The Chinese real estate market is not at its worst but getting worse, says a renowned real estate expert in China. This statement perfectly encapsulates the current state of the real estate market in China. The once thriving industry, which represented a pillar of wealth and prosperity, is now facing an unprecedented downturn. This is not a mere seasonal fluctuation, but a deep-seated crisis that has been years in the making. The signs of this downturn are evident. Property prices are falling across various regions, sales are sluggish, and there's a constant stream of bad news from real estate companies. These companies, which once boasted robust growth and sky-high profits, are now grappling with a slew of challenges. The crisis faced by real estate giant CountryGarden is a case in point. With the potential default risk of its dollar bonds, the company is on the brink of a financial catastrophe. CountryGarden, a heavyweight in the real estate industry, primarily operates in third and fourth tier cities. At the beginning of this year, the company had around 1,010,000 properties that had yet to be delivered. This looming crisis signifies that the hard work of millions of families could potentially dissipate into thin air. The situation is further exacerbated by the chilling winter that the real estate industry is currently experiencing. Not only are property prices falling and sales cooling off, but real estate companies are also bombarded with a barrage of grim news. Just a few days ago, real estate behemoth CountryGarden faced the risk of defaulting on 2 of its dollar bonds, triggering a debt crisis. The crisis implies that the hard work of millions of families might turn into a mirage. This chilling reality underscores the severity of the situation. It's a stark reminder of the precarious state of China's real estate market and the potential consequences that could ripple through the entire economy. Or with the economy in constant decline, the collapse of the real estate industry, once a pillar accounting for a third of China's GDP, will further shrink the wealth accumulated by the public over decades. The fall in housing prices will have a profound impact on individual wealth, local finances, banking, and the foundations of the Chinese government. According to the China Economic Daily Society's 2019 China Household Wealth Survey report, urban household net property value makes up 71.35% of individual wealth, and for rural households, it's 52.28%. The real estate downturn will cause a significant reduction in this wealth. Many families might face the loss of their accumulated wealth and even bankruptcy. The downturn also spells trouble for local finances. For years, land sales have been a major source of revenue for local governments. With the fall in real estate prices, this revenue stream is drying up, leaving local governments with a financial shortfall that could impact their ability to function normally. The banking sector is also at risk. Banks have extended vast amounts of credit to real estate developers. As property prices fall and developers struggle, the likelihood of loan defaults increases, potentially leading to a banking crisis. The real estate downturn could also undermine the foundations of the Chinese government. Its legitimacy has been built on the back of China's economic growth, and the real estate sector has been a significant part of that growth. As the real estate sector struggles, so too does the economy, and this could shake the foundations of the Chinese government. In conclusion, the downturn in China's real estate market is not just a matter of falling house prices. It's a crisis that could have far-reaching impacts on individual wealth, local finances, the banking sector, and the very foundations of the Chinese government. It's a crisis that needs to be carefully managed to prevent wider economic and social instability. From a demographic perspective, the decline in real estate prices is a long-term trend. Before the pandemic 3 years ago, approximately 93% of resident families owned a house. In 2022, authorities announced that China's population started to shrink. However, multiple sources verify that during the pandemic, the number of deaths in China was astonishing. According to data published by China's National Bureau of Statistics, there were nearly 14.65 million newborns in 2019. Yet, It's estimated that in 2023, the number of newborns will be less than 8 million, pushing the birth rate back to levels seen almost a century ago. This roughly 45% reduction in births from 2019 to 2023 confirms the sharp decrease in the population of younger childbearing age during the pandemic. If we consider the entire population of 14 billion, a 25% mortality rate calculates to over 300 million deaths. The Chinese Communist Party may attempt to conceal the real death toll, but the market does not lie. Many third and fourth tier cities have seen their housing prices fall by a third, which corresponds to a population reduction of about 25%. This drastic decline in population led to a decrease in housing demand, subsequently causing a significant drop in housing prices and a severe economic depression. Public data shows that due to the continuous downturn in housing transactions, the sales volume in 100 typical cities dropped by almost 40% year-on-year in July and fell by nearly 27% month-on-month. Moreover, because of the severe economic depression and high unemployment rate, Chinese families are unable to afford houses. The sharp decline in real estate prices can be attributed to the significant reduction in China's population. The decline in the real estate market will result in a significant shrinkage of the wealth of the Chinese people. This statement sets the stage for a discussion about the profound impacts that a faltering real estate industry can have on local governments and banks. Local governments, which have been heavily reliant on revenue from land sales, are in a particularly precarious position. For 2 decades, they have been selling land, with total income nearing 70 trillion yuan, a staggering increase of 6,400%. On average, over the last 15 years, revenue from land sales accounted for approximately 25% of total government income. However, as property prices tumble, these same governments stand to lose a significant source of income. This could lead to a situation where they are unable to maintain operations, including paying civil servants' salaries. By the end of 2022, local government debt was estimated to be around 100 trillion yuan. Moreover, the 6 major state-owned banks have seen an increase in the non-performing loan rate for individual housing loans and real estate public loans. This is a clear indication of the impending financial crisis for these institutions. The precipitous drop in the housing market is set to trigger a double crisis in local finance and banking. In addition, a downturn in the real estate market can have a domino effect, leading to a decline in investment and demand in related industries such as construction, steel, and home appliances. Trusts, stock markets, and bond markets related to real estate are also likely to take a significant hit. To sum up, the fallout from a declining real estate market is far-reaching, affecting not only the wealth of individuals, but also the financial stability of local governments and banks. The cliff-like fall in the housing market will trigger a double crisis in local finance and banking. The downturn in real estate is shaking the foundations of China's economy. At this point, you may be asking, what is the Chinese government doing to respond to this crisis? The answer may surprise you. The government has tried to stimulate the housing market through measures such as lowering down payments and interest rates, loosening household registration restrictions, and promoting urban village renovations and affordable housing construction. However, these measures have proven largely ineffective. One might wonder why these efforts have not yielded the desired results. The answer lies in the fundamental factors that are driving the downturn: a declining population, the exodus of the wealthy, and the increasing impoverishment of the poor. All these factors have led to a decrease in demand for housing, making it impossible for the government's attempts to stimulate the market to succeed. Moreover, the government's response has been hampered by the sheer scale of the crisis. The current situation represents not just a downturn, but a potential collapse of a pillar that has supported the Chinese economy for decades. In this context, The government's measures can be seen as trying to put a band-aid on a gaping wound. The future of China's real estate market looks grim. The sharp decline in housing prices, coupled with a potential double crisis in local finance and banking, could lead to a significant contraction of the Chinese economy. If the current trends continue, it's possible that the real estate market could return to the state it was in around 2000, when the average housing price in Beijing was about 1/10 to 1/20th of the current price. In conclusion, the downturn in the real estate market poses a severe challenge to the Chinese government. The legitimacy of the Chinese government, which is built on the high-speed growth of the Chinese economy, is now being shaken.